In this video, we're going to cover how to calculate maximum loss, maximum profit, and the break-even point on vertical spreads. Anytime you're investing, you should understand how much you could lose and how much you could make in your investment, as well as what it takes for you to at least break even. Vertical spreads are limited reward, limited risk strategies. Well, there are two basic categories of vertical spreads: bullish verticals and bearish verticals. Those two categories can be further broken down into two additional categories: debit and credit spreads. A debit spread is a vertical spread where the option you're buying costs more than the option you're selling. This creates a net debit to your account. Bull call vertical spreads and bear put vertical spreads are debit spreads. In a debit spread, the most you can lose is whatever you spent to get into the trade. The most you can make is the difference between the two strikes minus the debit. For example, if you have a bull call spread where you bought a 45 strike call and sold a 50 strike call, and you paid $3 net to get into the trade, the most you could lose is $3. The difference in the strike prices is $5. That leaves $2 left over for profit potential. In a vertical spread, the most you can make and the most you can lose will always add up to the difference between your strike prices. The break-even point is the price at which a stock needs to be trading at expiration in order for the trade to show neither a profit or a loss. To calculate the break-even in a bull call spread, you add the net debit of the trade to the long strike price. In our previous example, our break-even would be $48. We get this from adding our net debit of $3 to the long strike of $45. To calculate the break-even in a bear put spread, you subtract the net debit from the long strike price. Keep in mind that these break-even and max loss and reward numbers only apply at expiration. Prior to expiration, fluctuations in anything that could change the extrinsic value can change the value of a spread. Bullish put verticals and bearish call verticals are credit spreads. In a credit spread, the most you can make is the credit you receive. The most you can lose is the difference between your strike prices minus the credit received. For example, if you have a bear call spread where you sold a 45 strike call and bought a 50 strike call and received a credit of $2 for the trade, the most you could make is $2. The difference in the strike prices is $5, and that leaves $3 left over for loss potential. Remember, in a vertical spread, the most you can make and the most you can lose will always add up to the difference between your strike prices. To calculate the break-even on a bear call spread, you add the net credit of the trade to the sold strike price. In our previous example, our break-even would be $47. We get this from adding our net credit of $2 to the short strike of $45. To calculate the break-even in a bull put spread, you subtract the net credit from the sold strike price. Again, these break-even and max loss and reward numbers only apply at expiration because prior to expiration, fluctuations in extrinsic value can change the value of a spread. Knowing your max reward and your max loss in a trade can help you win position sizing and setting your target exit points.